In this video, we are going over 5 of the best healthcare stocks that you can buy today. If you have some extra money and have a positive outlook on healthcare, then these are, in my opinion, some of the best healthcare stocks that you can buy for long-term growth. By the end of this video, you'll have a full analysis on each of these 5 companies and you'll know which ones you might want to invest in. So with coronavirus ravaging the world, the economy has seen some pretty massive hits as well as rebounds in the past few weeks. We saw the market dropping about 30% before rebounding, but the overall market is still just below the all-time highs. We're also in danger of dropping again just based on the unemployment numbers, the mortgage defaults, and the resulting domino effects. Before, we never thought we would experience a medical pandemic just like this. Now we know that our health is vulnerable. As a result, there's a lot more attention directed towards the healthcare, biotech, and pharmaceutical industries. Basically, we want to protect ourselves from any future pandemics. Healthcare companies have done especially well over the last 12 months, beating the S&P 500 by a wide margin. In the last year, they are on average up by at least 18%. Healthcare stocks also tend to perform well late into the economic cycle, as well as during recessions. So without further ado, let's get into my top 5 healthcare stocks that you can invest in today. Number 1 is GILEAD, ticker GILD. This is a biopharmaceutical company that researches and develops drugs. Right now, GILEAD is trading at $73.34 per share with a 52-week low of $60.89 and a 52-week high of $85.97. They're down 15% from their high, but not long ago, they were actually down 17% from where the current value is. GILEAD has a market cap of $92 billion, a respectable PE ratio of 18.82, and an earnings per share of $3.90. Right now, their dividend yield is a solid 3.68%. If we zoom out on the graph, we can see that they've been going up a lot since mid-January. They hit a high at the end of April, and recently they've come back down. GILEAD's forward price to earnings ratio right now is 12.08 with a price to book value of 4.2. They have a very solid profit margin of 21.84%, and the return on equity is 22.29%, which is very good. I like to look at companies' current ratios, which is their current assets over current liabilities. And right now, GILEAD is sitting at a very nice 3.04. This means that they have 3 times the current assets as they have current liabilities, putting them in a very strong financial position. It's always interesting to see what analysts rate. So if we take a look at the analyst ratings, where a 1 is a buy and a 5 is a sell, right now they are at 2.6, which means they are just between a buy and a hold. The average analyst price target right now is $80.39 versus the current price of $73.34. Recently, you may have heard of GILEAD through their drug remdesivir. This is a recently approved treatment for COVID-19 patients. This is the first drug which has been shown in phase 3 clinical trials to be effective. It's not a vaccine, so the problem is when a vaccine is developed, this drug will stop making sales. However, this could be a one-time large cash inflow for GILEAD. Like I said before, GILEAD has a great dividend payment of 3.68%. Since they started paying out this dividend in 2015, the dividend amount has increased by over 50%. It's always a good thing to look at the dividend trends to see if they're going to continue paying this out. So overall, I do think that GILEAD is a good long-term buy. There's a lot of good trajectory for this company. I would say don't buy this stock just because of the drug remdesivir, because that's not their strongest point. It'll be interesting to see how this drug does when applied to more moderately ill COVID-19 patients. So good long-term buy. Price is a little bit high right now, so it really depends on when you want to get it. Next up on my list, number 2 is ABBVIE Inc. ABBV. This is an American biopharmaceutical company. In 2011, Abbott Laboratories split into 2 publicly traded companies, one called Abbott Laboratories and one called ABBV, which is more of a research-based company. They own other companies such as Imovin, Pharmaceuticals, and they will soon own Allergan, which is the maker of Botox. Right now, ABBV is trading at $92.10 with a 52-week low of $62.55 and a 52-week high of $97.86. They are down 6% from their highs, but in mid-March, they were actually down 33% from the current value. They have a market cap of $162 billion and a PE ratio of 16.3. Their earnings per share is $5.65, and they have a dividend yield of 5.07%. That is the highest dividend yield on this list of healthcare companies. If we zoom out on the graph, we can see a huge drop in February with a huge rebound starting in mid-March. Right now, AbbVie's forward PE ratio is 9.45, and they have a very high profit margin of 24.77%. Their current ratio is at 3.14, which is very strong. And based on the analysts, right now ABBVIE is at a 2.3, meaning that it's a mild buy. Their average price target is at $93.69, which is just above the price of $92.10. Overall, ABBVIE is a good growth and dividend stock. Its acquisition of Allergan was originally met with a big sell-off, and this resulted in stock price going to the low 60s. However, it seems like people have actually started liking the idea of this acquisition, which I do agree with because I do believe that these two companies can come together together and create more value. Now, why is that? Well, ABBVIE's US HUMIRA patent will actually expire in 2021, and this will obviously affect their earnings. Right now, HUMIRA makes up over 50% of their total sales. So therefore, this acquisition is a much needed way of diversification for this company. Allergan has very high profile drugs such as Botox, which allows them to get into the medical aesthetics industry. This acquisition will add a lot of debt to ABBVIE's balance sheet, but with the cash flowing over $20 billion annually, I don't think this will be a problem. Its current dividend of 5.07% has been increasing every single year, and with the increased cash flow from Botox, I do think this won't be a problem to maintain. So I do think that this could be a good buy if you are optimistic about the medical aesthetics industry, as well as the performance of Botox. Personally, I do see an uptrend in the medical aesthetics industry as the taboo of Botox sort of goes down. Watch out for their debt levels, but I do think that they will continue to pay out this 5.07% dividend. And of course, don't buy a stock just based on the dividend. It's always just an added bonus. Number 3 on my list is Illumina, stock ticker ILMN. This is a company that focuses on the analysis of genetic variation as well as biological function. Right now, Illumina is trading at $354.70 with a 52-week low of $196.78 and a 52-week high of $380.76. They're down just 7% from their all-time high, but recently they were down over 45% from its current value. So huge increases in price recently. Illumina has a market cap of $52 billion with a price to earnings ratio of $55.92 and an earnings per share of $6.34. If we zoom out on the graph, we can see that there was a huge drop with the market and then it shot back up starting in mid-March. Illumina has a forward PE ratio of 59.88, which is very, very high. In fact, it's even higher than its current PE ratio. So this will scare a lot of value investors. Illumina has a price to book ratio of 11.35 and a profit margin of 26.49%, which is very good. Their return on equity is also very good at 21.48%. And this company has a very good current ratio of 4.10. The analysts currently say that this is a 2.3, which means that it's a mild buy. And they've set an average price target of $324 versus the current price of $354.70. So the target is quite a bit lower. Illumina has seen a 13.7% annual growth rate over the last 5 years. Like I said, they have a very high 26.49% profit margin, which is decently high for the healthcare and biotech industries. Overall, I do like Illumina's long-term prospects. Illumina is very advanced with their technology, and this technology is imperative in the use of genetic sequencing for cancer research. If you're not too familiar with genetic sequencing, just know that it's a system that many companies use to diagnose genetic diseases. If you believe that genomics can change the way that cancer patients are cared for, then Illumina could be a very good buy. Right now, their strength is in their short-read genetic sequencing, but they are actively working on their long-read genetic sequencing as well. With many other companies developing other technologies and methods, this means that the competition could get more stiff in the coming years. So I don't think Illumina could bring big gains in the short term, but I do think that it is worth holding on to if you want to invest in a very solid company with lots of future growth opportunities, as well as being able to change many lives. Right now though, it does seem quite expensive. Okay, number 4 on my list is the Vanguard Healthcare ETF, VHT. VHT was started in 2004, and it's a fund that seeks to track a specific US healthcare index, focusing on low, medium, and big healthcare companies in the US. I wanted to include an ETF in this because if you've seen any of my other videos, you know that I love index investing. It's a good and safer way to invest in an industry versus buying shares from individual companies. Right now, VHT is trading at $191.02 with a 52-week low of $138.11 and a 52-week high of $197.80. They're very high to their all-time highs, and you can see that it's been up significantly since mid-March. This fund does have $11.78 billion in assets with a current dividend yield of 1.57%. Its year-to-date return is negative 0.56%. And one of the best things about Vanguard ETFs in general and this ETF are the low expense ratios, and right now this one is sitting at just 0.1%. It has an average PE ratio of 23.13 and a price to book ratio of 4.05. You can see that pretty much everything is in healthcare stocks, and its largest holdings are in companies like Johnson & Johnson, United Health Group, Pfizer, and more. Like I said before, Vanguard is one of my favorite investing companies just due to their low expense ratios. Their funds are always good at tracking the index, and it's a very easy to use platform, which I personally use for my retirement accounts. This is a hands-off, buy it and leave it type of investment for healthcare. Number 5 on my list is Johnson & Johnson, stock ticker JNJ. This is a company that develops medical devices and pharmaceuticals. I do think that this is one of the better healthcare dividend stocks. Right now, J&J is trading at $144.37 with a 52 52-week low of $109.16 and a 52-week high of $157. They're down just 8% from their all-time highs, but their current value is actually 25% higher than where it was just a couple months ago. Johnson & Johnson has a market cap of $380.61 billion, with a PE ratio of 22.53, an earnings per share of $6.41, and a dividend yield of 2.75%. If we zoom out on the graph, we can see that we saw a big drop at the start of February all the way to mid-March, and then we saw a huge rebound to its all-time highs. However, since then, it's dropped about 8%. J&J has a forward PE ratio of 19.05 and a price-to-book ratio of 6.35. They have a very solid profit margin of 20.75% and a return on equity of 28.55%, which is very high and a good thing. They have a pretty solid current ratio of 1.31. And based on analyst ratings, right now J&J is at a 2, which means that it is a buy. The current average price target is $164.17 versus its current price of $144.37. If we look at their Q1 numbers, we can see that there was an increase of 3.3% in their sales for this last year. We also saw a 55% increase in their net earnings. J&J is a solid company that has been paying out growing dividends for many, many years. It doesn't have the highest healthcare dividend rate, but investors like them just because of how solid their financials are. Last year, Johnson & Johnson paid out 51% of their cash flow as dividends, which is pretty reasonable. In the news, Johnson & Johnson recently stopped selling their talcum powder in the US and Canada due to concerns of it causing cancer and also lack of demand. Yes, they are facing quite a few lawsuits, which is a bit troubling. Johnson & Johnson is also hurt in its medical devices unit, but its pharma and consumer segments have been doing quite well. Johnson & Johnson is definitely one of the most popular healthcare stocks to invest in. You know, right now the price is a little bit high. Some people say it's high, some people say it's low. So just take note before buying. It's really hard to time the market on these things. So yeah, those are my top 5 healthcare stocks that you guys should be looking at. Healthcare is an exciting industry to invest in. And you can see in this video that a lot of these stocks have not been hurt by the pandemic. They've rebounded very fast. So that's maybe why healthcare could be a smart industry to put some of your money in. I always say diversifying is one of the safer ways of investing. Like always, make sure to do your own due diligence before investing in any stocks. Use my video just as a guide and make sure to do your own further research. If you guys haven't signed up for WeBull yet, make sure to do so and claim your 2 free stocks worth up to $1,400. I use this platform for my own trading and it's very simple to use, quite powerful, as well as completely free. Anyways, thank you guys so much for tuning in to this week's stock video. I hope you guys got a lot of value out of this video. If you did, make sure to share it with a friend and also like and subscribe if you want to see more videos just like this. I make a ton of videos about personal finance, investing, and entrepreneurship. That's it for today. I'll see you guys in the next video. Peace.